Okay, we're recording. Hello, everyone. We are again here with Paul McGlone, CEO of Sync Machines. They recently reported an amazing trading update with record automotive royalties and record results. So we are here to dig a little bit deeper into what's evolving in the company. You have this new announcement of robotics. So, what, let's start. How are you doing, Paul?
Oh, Hugo, firstly, thanks for having me again. Doing very well. Still here in London. Had a very full week of meeting existing investors and potential new investors, and that will continue into next week. So, really kind of quite pleased with the reaction that we're getting on the ground.
Great, great to hear that. So there's lots of things going on with the business. Some people have been already looking forward to that, and it's not such a big surprise what's happening. But lots of people might be getting into the story as you have hit cash generation. You are now close to refinancing your convertible note, and next year it should be your first year with strong cash generation. So let's dig into every bit of the company, the segments, the future with robotics, what's happening with aftermarket. Let's start with automotive. Like the big KPIs, the headline was you had over 2 million units for Q4. I was not expecting that until a couple quarters. So it's great to hear that that's happened much faster. So the question here is, why that happened faster? And what's your outlook into the coming quarters as new programs and new countries like the UK and Australia should add more volumes?
Yeah, I think the number that we recorded for the June quarter was right at the top of the range that we provided several quarters prior. So it was really pleasing for us to see that more bullish outcome, but it was within the range that we thought were possible. And that's really a function of the customers that we have that produce in the EU and Europe more broadly. So for us, we were kind of hoping for the top of the range, and it's come in there. So we're real happy. But I think GSR was live 7th of July. The customers that we have, I think, universally wanted to be well prepared for that. I mean, we thought the ramp up would occur in the prior December quarter. And so the prior December quarter for us was a little bit disappointing. But what it did show was that all of the OEMs were very well prepared for the date and kind of managed it in a way that would, minimize cost and all of those other things and just, push out the volume when they needed to. But the one thing I would say is that, of course, it's not a full quarter of the GSR requirements because it was only live in July and the quarter ended the 30th of June. So there are a couple of factors I think that are important here. We think we will see continued growth over the next 2 quarters. Obviously not at the same level because the GSR event is kind of a step change event, right?
Yeah.
So we think of that as it's like a 4 to 5x increase on the prior baseline of 4 to 500,000 a quarter. The new baseline will be in the 2 point something millions. That's really important, of course, because it's the new baseline for underlying cash flow. But so in this next quarter, we will see a full quarter of the GSR impact. So we're expecting some growth out of that. But also we have a couple or three programs that had only just started production or in fact are not quite at production, but will be in the next month or so. So that should see us delivering some growth 2 quarters out from now. So, we feel pretty good about the trajectory of royalty growth over the next 2 quarters. And of course, that resets the cash position. And then it's a question of, all right, what is the medium-term outlook for the penetration of driver and occupant monitoring further throughout Europe and into those countries that are not regulated, into Japan, where the regulations are coming soon, but they've been early adopters anyway. And then, of course, into North America, that's driven by, level 2 semi-autonomous driving, with regulations probably in the 29 to 30 timeframe. So, in the long run, we do see very significant growth from here. I think, in the middle, for maybe a year or so, the big jumps in growth may be moderated, but there'll be a second step change as the rest of the world hits regulation.
Okay, so as I understand, we will see probably a stabilization towards the high 2 million or mid 2 million range, and some growth from that, and then we will see the next step change as Japan and the US, which are huge markets, enter into the game. Okay, that's very exciting. The other factor that determines these royalty revenues is ASP. It's held slightly stronger than you expected. Looking forward over the short term, we know it's very volatile. It depends quarter on quarter, the mix of vehicles that are produced. But over the long term, what's in your control and what's not in your control regarding how ASP will perform and how can you ensure it remains higher?
So what is within our control is the way we price. And we believe we price fairly, and our pricing always is, we refer to investment grade pricing internally. And this is a very important concept because what it means is you must price at a level that can cover your overheads and your future R&D obligations. And there's a false economy in winning volume at a price that can't sustain that. So it's fair to say on, some programs of work that we don't win, where we still actively pitch but don't win. Typically that's because we walk away for reasons of price, right? So we're quite disciplined in the kind of floor price required to sustain investment. And, the entire industry should understand that, but most importantly, customers. There's just no advantage in squeezing prices to the point where R&D can no longer be afforded because, they don't get what they need. So we have a really rigorous view around this. So the first point of ASP that's within our control is we price that way. The second thing is typically we price in kind of 2 at least or 3 bundles. So a customer may want a very basic bundle for the lowest value vehicles, ticking just the boxes. And then they often have a mid-range of features and performance, and then a high range of features and performance, right? But I think what we've learnt from the ADAS rollout, and in fact all software, including the early stages of driver monitoring systems, particularly those sold throughout Asia and in particular Korea, I mean, what we found is that customers can push back very severely if software is a bit loose, I'll call it, delivering high levels of false positive. Firstly, it annoys the driver. Secondly, it renders the safety objective redundant because the driver pays no attention to it. But thirdly, it has great potential to destroy the brand. Yeah. So I think OEMs are at the early stages of, taking steps to make sure that the brand's protected, but also that the initial objective, which was safety, is actually being delivered. There's no point having a beeping car if it ticks a box that isn't actually delivering the safety outcome and has the potential to wreck the brand. So looking at these different levels is important. So we know that pricing going in. What we don't often know is what the take rate of each bundle will be. But what we're seeing is in these early stages, a lot of our customers are gravitating further towards the higher feature bundles and high performance bundles than the lower. Now, it's going to take another quarter or two before we see how that actually, flows through in full. But they'd be the key reasons in terms of our pricing, customer behavior that's held up ASP. But I think the third and final reason is really core to how we do business. And I've said this many times before, but we take a full systems approach to the opportunity where we get heavily involved in the optical design, certain elements, components within the bill of materials, silicon selection, the price performance difference between different options. And as a consequence of that, we often present to our customers a way to reduce the BOM. And if you can do that, well, then that takes pressure. If you're only providing software and leaving everything else up to somebody else, the natural tendency is for procurement to seek reductions in the software. So we take a philosophically different position on value versus price. And up until now, that plus the other two characteristics that I've just mentioned seem to have worked very well for us, and certainly by comparison, very well.
Yeah, I think that's a very misunderstood point about seeing machines. Usually when I talk with other investors that are not that familiar with the company and the sector, they usually argue that, your main competitor's cost base, it's much lower. And therefore, many people see this as a better opportunity to just play the royalty ramp up. But, in the long term, we are starting to see that having better systems, being involved more into the OEM process has less churn. It takes the programs from 0 to 100%. You have low failure rate. It's if you believe in this technology long term, it makes sense to have that stronger base.
Well,
so, yeah.
The other thing I'd say is, and we get that question quite often also, and to work in that sort of total systems approach environment, it is an extra overhead, that's for sure, and that's there are two reasons our cost base is higher than our competitors. That's one, but it's probably at the margin. The other is that we have a large, well, relatively large, hopefully soon to be much larger, but a larger aftermarket business, which has a bigger workforce. I mean, we still deliver services at north of 60% margin, but of course, compared to pure software, it looks expensive, right? So you've got to be a bit more clinical about how you break down the business, and making a direct comparison top line to top line or gross margin top line to top line is just a bit inaccurate. And we're not hiding away from our average margin, which is 75%. But if, say, you compare it to a pure software play that's 90% or 85%, on first blush, someone can say, "Oh, your costs are way too high," or but when you look at the ASP per unit, and then you look at the cash contribution per unit, we're typically 2x better than the next player.
Yeah. And, that's definitely very interesting. There's another angle I would like to touch on Automotive, is China. You are seeing a big acceleration into DMS requirements in China. It seems like local OEMs don't have the technology, and they either need to increase it and improve it really fast, or customers need to, have 300 bips per minute, or either they can try to partner. How you play in China? I've seen some news that Valeo and Magna might have some business there. Are you with them? Is this just pure optionality? Are they just too cheap?
So look, our customers have long-standing, significant businesses in China. All of our tier one customers. As we look at this specific niche market, driver and occupant monitoring, and we split China into two groups: China domestic, China export. And then I'll come back to China export in a minute. But I think it's well known that there's a significant degree of subsidization that goes on in the Chinese automotive supply chain. But many people think it's just with the OEMs. It isn't. It's across the whole supply chain. So there are a number of providers of driver monitoring software in China, and their product goes into the local domestic market OEMs at extremely low rates. Certainly not a rate that would meet any criteria for reinvestment grade pricing, as I mentioned, regardless of the volume. So that, to me, is a red ocean and to be avoided at all costs. I don't see any advantage there at all, if you're selling the kind of software that we're selling. Now, and the other thing is that the Chinese market is if it's not become already, is becoming rapidly saturated. And that's one of the reasons we're seeing massive expansion of exports, right?
Yeah.
So I don't think there's anything good economically that's going to come out of that domestic market, certainly for an outside player.
Yeah.
So avoid. And therefore, whenever we look at our numbers, market share, expectations, long-term forecasts, we exclude that entire volume from the numbers. Chinese exports are a different story. Now, I'm not going to pretend that we've got this covered completely or anything like that. So just to be clear, but our approach has been careful, but we do believe the way the regulations are set in the most regulated market, which is Europe, we do believe that our experience with the regulators and our experience with European OEMs, the fact that our software performs at a level that exceeds the requirements, not just today, but will exceed the requirements of future NCAP and GSR performance criteria. This is very attractive, particularly to those Chinese OEMs that are acquiring excess production capacity in Europe. Now, there are a whole range of other factors that European markets are contemplating that are, above my pay grade, things like protection and all of those things and data security, cyber security, all of those things will play out in time. None of them are simple. They're quite interconnected. But I think having software that can perform today and tomorrow removes the risk from those players. And certainly the early dialogue that we're having is positive. So that's our approach to that group. But pouring into a 20 million unit market that's at less than $1 and littered with competition, with procurement cycles that are 1 year, not 3 years, I don't see any economic rationale for that.
Okay. Thanks for that. Then, I think what we've covered pretty well the automotive business, to make a quick summary, very high growth market with step up changes. We are seeing the first one, we shall still see some growth. In the middle end, you have some smaller countries applying that will drive some volume growth. But the next step change is 2029, 2030. That's not too far away, to be honest.
In car years, it's very close.
Yeah. and yeah, for the people that don't know the company listening, the very interesting thing there is that those are pure royalty, 100 gross margin business, and they have already covered their operating expenses. So basically, each extra revenue from that goes straight to cash flow. So that's extremely attractive in my view. Then let's go on the aftermarket, because many investors that are not really familiar or have not speaking with you as closely as me and other people I know, think and they are disappointed about Guardian 3. Like, you have Guardian 2 that was working not amazing, but was working well. You sold around 4,000 plus on average per quarter. Then you spend a good amount of millions into developing Guardian 3 that promise higher margins both in the hardware and the monitoring side. And so far, volumes have been fairly disappointing. First of all, what mistakes have been made in this deployment? What has happened for this to be a failure for the moment?
And look, it is disappointing to us for certain. And before I get into the reasons and what we're doing about it, as we go through this year, we've made some changes into that business unit, and that team will be reporting directly to me for the rest of this year. And so I'm really shifting, now that we've got some of the other parts of our business well under control, automotive costs, for example, we're really shifting a lot of executive effort into supporting the team to move this part of our business forward. And that's really the last missing piece in being able to generate strong double-digit growth and high margin. So it's the last missing piece. I do believe it can be done, and that's our job from here on. But in terms of the history, without sort of getting into minutiae, and I think everybody knows I've spoken about this openly many times, as we were developing that product, right at the end, we had a series of technical issues that took far longer to resolve than we thought. And as a consequence, we were late with that product, perhaps a whole year late. Okay. Now, in that year, lots of things changed in the marketplace. Competition, the general economic environment, a whole range of things changed. And I do believe if we had met our original timetable, we would be in quite a different position. But that time's passed. So we've analysed that. We've done our post review. We've got the lessons learned, and we're moving forward. So then let's look at, well, why isn't the run rate of sales anywhere near our internal target, which I think we've been very public about? We want to get this business to 6,000 units a quarter of hardware. 6,000 units a quarter of hardware delivers roughly $2 million of annual recurring revenue. So that's kind of that step change that we want to make, say from Q4, 3,500 to 6,000 on a consistent basis. So that's what we're still extremely focused on that. So why isn't that happening? Well, so I'm just going to give the reasons, and these aren't excuses for us. These are just realities that we must overcome this year. So that's the first point. We're taking responsibility for them, but there is an economic environment in the transporters that we target, and we target heavy freight that carries expensive goods, dangerous goods, or people, public transport. Those markets over the last few years have been severely impacted by rising diesel prices and other costs, and we've all felt it in the cost of living. So this is not a surprise. But what it's done is it's delayed decisions where capital is involved. The trials that we've had numerous trials in place, they're running longer. And you've got a choice. Do you chop it off when you said you would and just cut the relationship, or do you keep going? So we've elected to keep going. And we're still in conversations with customers and existing and new customers, existing for expansion and new customers for making the first decision. We still have a number of those in play, but they've all been delayed over the course of this year. And I would say, and I have said quite publicly, that there are 4 or 5 of those, of which any one could change the trajectory of the business this year. So what are the complications? Well, it's delayed decision-making, essentially for CapEx. Okay, so can we solve that by offering a different business model? So we're trying that, and we'll see how that goes this year. But there are also, the further up the chain we go into enterprise-style customers, multi-jurisdictional customers, these days, the contractual requirements, the audit requirements, the safety requirements, the privacy requirements, the cybersecurity requirements. We used to have a contract that was 4 pages, and now it's 50. So you just put all those things together and it just reads delay. Now, that can't be the excuse going forward, because that's our environment. We need to overcome it. So looking forward, and I'm talking this fiscal year, we got some really key focus areas. We're looking at existing global accounts, and we're looking to leverage our experience in whichever market we have a position into all the markets in which we operate. So we've got a dedicated team looking at global accounts. Looking at existing customers where we're not 100% penetrated. So this year, we're doubling down our efforts, and we may use price or business model. We'll experiment with a few different approaches to try and increase penetration. So that's organic growth. Distribution. We've actually put on a new guy, Naveen, who's going to run distributors. That's his expertise. He's ex-Geotab, very good guy. Already hit the road running with some great ideas for how we move forward in terms of managing existing distributors, but also bringing on new distributors. Our relationship with Mitsubishi Americas, that's been really interesting too. So we've worked with them all of last year on kind of a referral agreement, using their own teams to try and sell our product. And we jointly have sat back from that and said, look, that wasn't as successful as we'd hoped. So let's make a change. So we've made a change to our US team, and the Mitsubishi Electric team have made a change as well on their own bat, and they're putting direct qualified resources into that initiative to work side by side with us. So that's all parts of the chain here are looking to make a difference, do something different in order to achieve the results. Then we have a couple or three big strategic opportunities, and some of them we've announced before. We still feel positive about those, but the timing has dragged on. But all the indications are still positive. So we have dedicated people focusing on those strategic accounts to try and convert them and get to paperwork as soon as possible. The final thing, which is really important, and if we're in an environment where the hardware is an issue, growing costs, particularly for memory, is an issue, CapEx is difficult for people. Well, we've taken an election we've always been thinking about this, but we're now moving full speed ahead, licensing our algorithms to existing telematics companies that offer, a driver monitoring system that they know and we know isn't really measuring fatigue at all. It's just essentially looking at the direction of the driver's head. So that's a false positive machine. So we've been approached, and we're already well progressed with one party to do exactly that. So this will be more like the automotive business model, but an environment where the intention is to derive a monthly license royalty per unit. Now, obviously a very, very large market, and gets us into, down from the heavy, dangerous, valuable freight market into the commercial and light commercial market, which is, infinitely larger. So I think we'll see results from that certainly this half in terms of moving forward, and this fiscal year in terms of generating revenue. So quite a lot going on there. And my point of rattling off all of those things is that, we have a really clear plan and people in place that own each part of that plan this year. And we think that ought to move the needle.
Okay, and understand that if we had to make a final summary, we could say, what are the things that are within your control that would mean for, let's move forward 1 year, and you say, if we have done these things, I'm satisfied with what we've done, no matter, the outside things you cannot control. What are the inputs you can control that will lead to a successful outcome? Yeah,
well, I think the key accounts that we're working on, that is a two-way street for sure, but, we've got to deliver our part of the bargain there. So we've doubled down on our focus. I think existing customers and global accounts, we're already in that business. So we've reorientated resources away from other activity to focus just on those two. And you'd have to think that, that is a classic relationship pipeline management exercise. The more effort you put in, the more results you'll get out. So we have to be confident that will yield results. And then finally, this push into licensing, that is a must do. So we want to get our first deal done in this half, having it generate revenue in the second half. And I'm hopeful that we can bring a couple of others in this fiscal year as well. So I think that's also within our control. And the key there is to pinpoint the parties that we know are in the market with a false positive problem. And we can solve that, and we can both win. Okay, and I'm interested here around the angle regarding insurers, because especially in the segment you are working on, I've been involved in some companies regarding insurtech, and usually they move really slowly until they see it works and they demand it for lower pricing, better risk selection. Have you been seeing anything of that yet in your markets, or it's too early yet? Well, we've actually seen it for quite some time. One of our Latin American distributors is kind of very closely tied to insurance. Our New Zealand distributor is very tied to insurance. In Australia, they've been a bit ambivalent. They love the product. They won't push it. They're kind of product agnostic, but they would encourage customers to use the technology. And if they did, they would get a benefit. So I think I think that it is a really significant opportunity. Now, I think once we get into some of the high volume markets, commercial and light commercial, and the proliferation of the technology expands, I think that's the thing that will make more interest to insurers that have, portfolios to manage rather than
Yeah.
just, here's a company with a fleet of 100 or 1,000 trucks. So, yeah, I think in the long run, insurance is very important. I think there will be an angle, but there's a bit of a tipping point issue as to how early they'll get on board and whether
Yeah.
they'll actively do something or just passively respond. So, yeah.
No, that's extremely interesting because we're seeing all of that with InsurTech. InsurTech has been going on for lots of years, but then finally they get the solution that works for a wide base of customers.
That's it.
We have Ting in the US, for example, for fire control, and that's now being pushed by Nationwide to everyone. And with the licensing point where you can offer low cost for wide fleets, that could be a really interesting growth vector. So yeah, excited to see how that develops.
Yeah.
Then we can get a little bit now into the spicier ventures, the more exciting ones. On aviation, I did some digging, and you won a contract in Australia with the Defense Department regarding some training programs. It was announced around 270 million over 10 years. I assume a small part of that is for seeing machines. But how's that progressing a little bit? I know it's a lower priority right now, but how's that evolving?
Yeah, look, it's kind of aviation is the way you describe it, a lower priority, not because of any other reason other than at the minute demand is constrained by the tier one that we've licensed to.
Yeah.
For all kinds of good reasons, by the way. But that will turn around. Now, on that particular initiative, the frustrating part about that is, the government announced it, the tier one announced it, they shook hands, got a plaque, and that was all announced. And we were even referenced in it somewhere, but we haven't got our paperwork yet. So we expect, I think, in the next quarter that will be finalised. So it is material. It's a military contract for pilot training simulation where they required Australian content. So really important. And of course, we're in numerous pilot training simulators today with Emirates, Qantas, and others. And this I'm hoping will actually give the whole aviation area for us a nudge forward.
Okay.
So, I've been caught out many times by talking about aviation agreements that were just around the corner and then ended up down the road instead of around the corner. But of course, someone else announced that, not me. And I've just been quietly waiting for us to get the paperwork rather than talk about it too much.
Okay, that's great. That's great. And then the new cool thing, it's robotics. I've been investigating, and it's really interesting the approach you are taking into vision systems for robots and smart factories. How would you describe this new opportunity you have? How are you controlling costs? When do you expect revenues or contribution? How are you going to fund it?
Yeah, look, I'll give you a scoop today, Hugo. Just to cover off some of those introductory points, this particular platform, what we're calling our physical AI platform, is a direct derivative of what we learned over 20 years, developing from single point DMS to OMS to occupant measurement to 3D perception mapping. So we've taken that technology evolution and we have found a natural home for it. So this is not like we're standing up a new pillar of R&D. We're not standing up a new business unit. This is essentially our platform approach to our existing technology with a single derivative that will apply to this new area of robotics, and industrial automation. So we've been contemplating it for a while, working on it actively for about 6 months with just a few people. As we announced the other day, we've been working on a proof of concept for a factory automation embodiment of this physical AI platform, and that's been extremely successful. And I expect as a result of that, with that customer and also with other customers, we will see that proof of concept expand into product development and ultimately licensing and royalties. Now, just to be clear, we haven't spent any time yet sort of saying, okay, well, before we start, what's the plan? What's the addressable market? What's the serviceable market? What's the ASP? I mean, it's kind of like, if you've seen the Eiffel Tower, it's the Eiffel Tower.
Yeah.
And if you've seen what's going on in robotics, that there's opportunity.
Yeah.
So that's kind of the approach that we're taking right now. But the rationale for us is we were able to move very quickly from what we've learned in the cabin of an automotive vehicle and apply it and that whole perception map concept to the notion of a robotic embodiment. And this is mission critical to the difference. We're not starting from scratch, inventing something, imagining what's possible. We're taking very specific, well-developed capabilities and, our sort of human-centered design philosophy, which we've been working on for years. And we just believe that can give robots, contextual awareness that's needed to really interact safely and intuitively with people in these more complex environments, whether it be the factory, the home, who knows, a hospital, a retail environment, a warehouse. So we're giving this sense of context to the machine. And in this case, it's not the inside of a car, it's a robot or a piece of factory automation equipment. So I think that's a key point when I'm asked questions about investment, capital, distraction. It's none of those things. It's actually a direct derivative of our existing product and our existing experience. So if you think about it, our automotive platform, a slight deviation to be a physical AI platform that can be applied to other assets. And in this case, it gives the robot or the piece of equipment a deeper understanding of the situation around them. We create this dynamic three-dimensional perception map of people, objects, the environment. Rather than simply recognizing individual features here and there, continually builds context and awareness. And this is what we do inside the cabin. And it understands, spatial relationships. It can interpret human behavior. Are you moving towards me? Are you happy? Are you sad? Are you ill? Are you falling? It can anticipate risk. This spatial awareness means it can essentially, forecast the human's direction and movement, which can happen for no reason if you think about it, and then enable the machine to make intuitive decisions in real time. Now that's all fancy, right? But if you think about it, each aspect of what I've just said, we are delivering today in the interior of a cabin in a full perception map of that interior. And the exciting part about this is we've been able to do that in an automotive world that requires very high performance at the absolute lowest cost, embedded at the edge. And I think once we get the community to the industrial community to understand this, I think we're going to be sitting here with a really material competitive advantage.
Yeah. Yeah, something I was quite excited on. A few months ago, I went into a webinar. One of your big shareholders has developed kind of a product for automotive. But I think it's with your technology, even you were not named. But it was impressive. They've developed an in-cabin that can detect your heart rate, looking at your skin. It can detect your emotions. It can see if you are going to have a heart attack.
Yes.
So if you apply that on a 3D setup in factory, that's incredibly useful. Like even just for monitoring outside of robots, that's really, really useful. And for the low cost, you are able to produce it.
Indeed. And then, and on top of that, the precision of eye gaze, the precision of hand movement, the ability to instruct the robot in a control environment just with gesture instead of equipment. And then if you think of the applications, all of the different industries, manufacturing, logistics, healthcare, aged care, warehousing, mining, industrial automation, all these areas where robots are not potentially, but where robots are either in place or increasingly expected to work collaboratively with people, you can see that all of those things come together. And this is kind of a natural place for us to launch, I think.
Yeah, that's extremely exciting. I mean, it's just, with a $20 camera to do all those sort of things instead of, a $1,000 camera you will usually need.
Or a $10,000 chip and a $5,000
Yeah.
camera, times, 1,000, 10,000, a million. So look, there's some way to go. So I'm not going to be too prescriptive on, as I say, markets, pricing. But what I can say is we've developed and had accepted this proof of concept way faster than our customer had ever anticipated were possible. And that's because it's derivative work of all of the things that have gone before. I mean, of course, we have some genius people that are able to do all of those things, but I'm highly confident that as we engage with more customers, and we've packaged up the solution in like what we call an SDK to enable these customers to experiment and experience what's capable. As we push that out to a few more customers, I think we're really going to get some traction. And the scoop is for you is that we're going to be launching on Monday. So we'll be launching a new website that lays out this capability in some detail. We're going to be launching a video that actually shows the practical application of the 3D perception environment, what it can do, the safety outcomes, all of those things. And then we'll have a campaign that will follow on from that, from there. So
very, very exciting, very exciting. Yeah. I mean, to make a quick recap here, huge automotive growth. We are still seeing the big step up, couple years of growth, another big step up. Then you have aftermarket that after years of, this transition, you are going hands-on, know that you have time, changing stuff. The product it's very good. Like if you look at any research, there's nothing that comes close to it, and there's a demand for it. But yeah, it's true that, if you look at any company out there that has trucks and they are suffering, so any of those type of solutions having a hard market, but that should grow. Any one of these deals, it's going to be a step change for the business, plus smaller ones. And then, 2-3 years out of the future, we have good optionality regarding robotics, and very, very excited to see that. No, some of the short-term concern that worries a lot of people, especially because you are in the London market. That's usually very, very conservative investors. It will be a different story if you were listed in the US. But you have this Magna loan. You are now in London, I think, to meet with some of the lenders. You are in the exclusive period. I know you are mid negotiations, finishing everything. So if you can say much, no need, but a little bit of an update around that.
Well, the trip to London is actually our standard twice-a-year trip. So we've released Q4 KPIs with our preliminary full-year numbers, which were, I think universally accepted as excellent. So we were going to be here doing this no matter what. And it just so happens to coincide with the timeline for getting down to documentation in our refi. So I'm not in a position to talk about the details as you well know, but we have gone exclusive with the parties. We are in the the actual production end of the conversation, and we're working hard to, get the deal closed as soon as possible. But just to be clear, we have a wonderful relationship with the corporate office of Magna, who hold this particular debt. We keep them up to speed with all of the things that are going on. And so they're comfortable, we're comfortable. We've got a deal that we think delivers us something really important in the way this refi is structured, and that's short to medium term flexibility. So what we wanted to achieve here is to, as we're just getting into profit and cash flow, we didn't want to be locked into strict principal and interest repayments from Q1 and get us into a situation where, for whatever reason, could just be a delay in royalty payment or something weird, that would cause an immediate stress. I mean, that's just a risk that is unnecessary. So we fought hard for a package that would give us some flexibility around principal and interest deferral for a period at our election, some, at the end of the deal, some principal pull forward on repayment, should we want to do that if we're performing better than we thought. So that level of flexibility for us was key in the arrangement. And you've got to pay something for that, right? But I think what we'll be presenting is a package that, on balance, when everyone looks at it, is reasonable in the circumstances, but importantly, gives us that flexibility and freedom to move.
Okay. And regarding dilution, I assume it's, the objective you have 0 to very, very limited dilution regarding equity.
Yeah, well, as I said, our key focus has been on flexibility in the arrangement so that we're not setting up an environment where we're, delivering our own stress, which is unnecessary. And so that's our objective.
Okay, perfect. Understand it. Then, I have a couple of last questions around that. A little bit, if we look at the company as a whole, what would you say that over the next 12 to 18 months, the main achievements or targets that you are looking for?
Okay, well, if I start at the very top, and that's really looking at the numbers, the way we see it. So, delivering a set of results that show the turnaround in profitability and therefore cash production within the regime of a new refinance that strongly supports the business in years 2, 3, 4, and 5. So that's kind of the first thing. So then the question is, how do we make sure that happens? Well, what's within our control? We are going to remain incredibly focused on costs and have a real forensic lens on any area of additional investment. So that's not to say that we aren't investing. We are. We still have a strong R&D team and all kinds of things like that. But this year we are going to be laser focused on making sure that we aren't investing in areas that have 4-year paybacks, right? So tightly controlled. We're going to double down our focus on automation inside the business to carefully manage our cost to serve. All of that's within our control. So that's probably a big priority for us. Then as we turn to automotive, we think there are some really interesting opportunities in our sort of existing core automotive business. Certainly we've got programs coming up in Japan and all of that, which everybody knows. But this sort of future mobility and autonomy area, we think we have an angle there, and the early dialogue with customers would support that position. So hopefully there'll be some movement in a slightly different direction to the traditional, which is important. But we're going to remain really consistent in the way we look at the automotive market, growth, new business, ASP, return on investment. So in particular, as we're set up to generate significant cash flow over, say, the next 3 or 4 years, I want to make sure that we're maintaining our return on investment through appropriate pricing going forward. Others can do what they want. And you might say, well, that might affect you, and it might. But what I know and what I've experienced here in the last 7 years is if you continue to deliver programs at 100%, you continue to collaborate, you continue to show a feature roadmap that is adding value to your customers, and then you really deliver on your customer's customer and what they experience as a consequence of that, that will be valued at some level. That's really important. And then finally, in our aftermarket business, we will find a way. And I think the mix will change between our current, total orientation towards hardware-related sales to more licensing. We'll mix and match. We'll experiment with pricing, business model. And this year, we're going to do whatever we can to try and zero in on the elements of that cause us to grow. That's the plan.
Okay, great to hear that. Just a closing question for you. What's the part of the business you are most excited about?
That's a double-edged sword question, Hugo, if ever I've heard one. Because if I say it's robotics, someone's going to say, "Oh, so auto's dead, is it?" So that's not the case, of course. But look, I am really excited about the potential and this pivot in aftermarket. I really think it's by far the biggest addressable market today. And once we find the right mix, I've always been, but fair enough, haven't performed against our own internal expectations yet, but I still think that is the biggest area of opportunity. So that's the key for me personally. That's the thing I want to achieve. Robotics will look after itself. The market will pull that along.
Okay, great to hear that. It's great. It's been a great conversation, Paul. Thanks for being here.
My pleasure, Hugo. See you around.
See you around.